On to our next guest now. Ryan Littlestone of Forex Analytics. He has over 25 years. You heard from him earlier on his prediction. He has over 25 years experience in financial markets and trading. His career began at Rudolf Wolf, where he transitioned from the back office to dealing in LME warrants, and then on the main execution desk, broking orders across the LME and every other major global market. Ryan now spends his time passing his knowledge, this knowledge to help inexperienced retail traders navigate the crazy world of trading. His focus is explaining data through the lens of fundamental and technical analysis. And in his presentation, Ryan will be breaking down a key market theme, inflation, and how one will need to adjust their FX trading strategies in response. So Ryan, the floor is yours.
Lovely. Thank you very much, ladies and gentlemen. As explained, my name is Ryan Littlestone. I've been in markets since 1990. As said, when it started on the London Metal Exchange, one of the founding members, Rudolf Wolf. I started right at square one in the back office, worked my way through to the order desk before helping to start and run a life law operation. And that's when I really caught the trading bug and decided to become a local and trade my own money. And I couldn't really have got a bigger wake-up call about what trading your own money is like compared to broken orders than I did that very first day in the pit. Because I remember the day as if it was like yesterday, standing there looking at the price screens, looking around at all the bids and offers being shouted around and having absolutely no idea which way the price was going to go at that very moment. So suffice to say, I had a lot of learning to do and to do quickly, and I'm still learning to this day. As every day markets have something new to teach us. My experience both in the institutional and the retail side has helped me immensely because I've been able to understand how both sides think and work. Now, I'm more of a long-term trader by nature. I like to really get stuck into the fundamentals to see where the big shifts in economies and thus central banks may start or change. And there's nothing better than a crisis to bring those big shifts. If we can see when those may start, we can then get an opportunity to trade right at or close to the beginning of big price moves and trend changes. Now, trading a more longer-term approach isn't easy. It requires a lot of planning and patience because big macroeconomic changes don't happen on a whim. It can take some months for things to start changing, and all the while the prices could be moving the opposite way of what I expect them to. But that's where the planning comes in. If I'm trading long term, I'll factor my risk over many price points to give me the room to be wrong for a period of time. The trading this way can also be good for the psychological aspect of trading. When trading long term, I become less interested in the everyday noise. One data point won't take me out of a trade, or a sudden price move won't scare me. Only if the fundamentals don't conform to my strategy over a long period of time will I look to assess the trade and decide if I'm wrong or not. Now, my most recent long-term trades, which I'm currently still in, are long dollar yen and short euro pound. And these were both from late in 2020. For the euro sterling short, it was a mix of the end of Brexit, in which I always said there would be a deal of some sort, and then to try and run as a virus recovery, stroke inflation, stroke Bank of England trade. The dollar yen trade has been another that tried to capture the virus recovery phase and a possible inflationary surprise, which, as we all know, we're firmly in the midst of now. And the funny thing with this trade is that it started from one simple question: what if central banks are wrong? Because back in 2019, 2020, central banks were all telling us there was no inflation. And so I sat there thinking to myself, wouldn't it be just right for it to appear, just as all major central banks were saying it wouldn't? Now, from that came a trading idea, which obviously relied upon a bit more analysis than that first question. But essentially, the strategy was based on trying to get in early on what I saw was a big fundamental change in economies and central banks coming soon, and how the Fed will be right in the thick of it. But I'm not here to cry about those winning trades. What I want to highlight is how it's possible to catch these big trend changes. And that brings us right to today's subject, trading in 2022 and how markets may react to inflation changes. Now, while they may not be a good thing for us personally, a crisis is what brings the best longer-term trading opportunities. The biggest aspect of those is obviously central bank expectations. What a central bank may or may not do drives 90% of what we see in markets each and every day. The economic data, be it inflation or jobs, all aspects of it causes price changes in various assets, either minutely or on a larger scale, obviously depending on what the data is. We see pricing and repricing of those expectations every day. But it's when those expectations swing wildly that the big trend moves come. And if we can get in early on a change in those market expectations, we can capture some huge moves. So that was the objective behind my dollar-yen trade. It wasn't so much on inflation coming, but what would central bank expectations do if it did? And thus the Fed has gone from late 2019 and pretty much all through 2020, telling us there was no inflation. Then to early 2021, telling us inflation would be transitory. Then to late 2021, telling us that it might not be transitory, and in fact, that they don't know where it will end up. Now, over that period of time, market expectations have changed from expecting the Fed to keep easing to now expecting some 6 hikes over 2 years, and maybe 4 of those this year. And hence, that's a big reason why dollar-yen went from 102.59 in 2020 to 116.35 this year. Now, the main point here is really it's been the change in expectations that have driven the price. And the only actual action we've had so far from the Fed is scaling back QE. Without the Fed actually changing their monetary policy rate, dollar-yen has risen nearly 1,400 pips. Now, that's very important because when we're trading expectations, we have to know when they've gone as far as they can. And I think we're at that point with the Fed. Right now, we're at peak Fed expectation, and the price action has confirmed that. After hitting that 116.35 high in dollar-yen, we've now fallen back. All while the market went super hawkish this month. We're at the point where the Fed actually hiking may cause a big buy rumor, sell fact move. We see the dollar sell off from such an announcement. So as I sit here today, I believe I'm at or very close to the end of my dollar-yen trade, as my strategy potentially has run its course, and now we're into the what next phase. Now, we all know that inflation is here, and so the path for central banks looks set. We've seen that tonight with the FOMC. The problems will arise if inflation does start pulling back over the months ahead, as that will get the market questioning the rate path for central banks like the Fed. How will markets react to that scenario? If there's a reason why the Fed may lower the path of rates, that will negatively impact the dollar, and by nature, see other currencies rise against it. So that brings me back to the how to trade 2022. So as one opportunity door closes, another one opens. And this door is yet another change in expectations. This trade idea also starts as a very simple premise. There's 2 sides to an FX pair. So if one stops moving based on its fundamental dynamics, what might happen on the other side of that pair? In this case, if we are at peak Fedness and the dollar has the path of monetary policy all priced in, what's the story with all the other central banks? If the dollar isn't going to go meaningfully from here, there's only one other way the price can go, right? So for 2022, my focus is on what the other central banks might do to deal with the inflation issue, and obviously the big one is the ECB. This is a central bank that has spent the last 10 to 12 years trying to get inflation up to near its 2% target. It's throwing trillions of QE and other acronyms at the task. It's been telling us the same story about the lack of inflation that the Fed has. And even now, in the face of inflation, when it's actually doing what the ECB wants, they are still unable to acknowledge it and even think about changing policy. So they've been easing to oblivion to help get inflation higher. And now they're going to fight that high inflation by continuing on that easy path. You know, do they realise how crazy that all sounds? So this strategy is another one looking to fight the rhetoric of the central bank and possible change in market expectations. The expectations for ECB to tighten have been very limited, but they are slowly growing. That's natural as the market sees data point after data point supporting reasons for the ECB to tighten. But the words from Lagarde and co are keeping those in check for now. And that smells of opportunity to me. Because if we are seeing a top in the Fed pricing, and if the ECB is going to be forced to start hinting that they might need to tighten, euro dollar is only going to go one way, and that's up. Now, the big question for any long-term trading is timing. Now, I've already got the itch to start getting long, and I'm trying to rein in the grand FOMO I've got and not jump in too early. I actually think that in the short term, euro dollar may drop before we possibly start seeing it move higher. I think that maybe an actual confirmation dollar jump on Fed action could be the last hurrah for the dollar and the Fed trade. So looking at the chart, we have some decent long-term support and resistance points. And it'll be those I mainly focus on when putting the plan together. Ideally, I'd like to start scaling longs if I see a move down to somewhere like 110. And I would add all the way down to those series of lows from 2015 through to 2017, that area around the 105s. Now, I may decide to buy all the way down to the fabled parity level, should I feel the strategy is still good. Now, when I trade long term, I judge my risk according to the price levels where, if passed, I'm likely wrong. So that 105 to 103 area would be my first main assessment point if the area broke. It's there I would gauge the price action, the market expectations, and the fundamentals to see if they're still valid for my strategy or not. If the answer is they're not, I'm more than happy to fold and take a loss. I'm not someone who hangs around in a trade that's wrong. So back to the chart, you can see I don't have a lot of indicators on there. When I start planning, I really only initially look for the major levels. And then from there, I build up the picture. As I don't know whether I'll get a decent dip or not, I'm not quite at the stage of picking an exact entry point. Once I do decide to start entering, I'll zero in on the charts in more detail and then get an idea of what I want to risk and how to place that risk over the price levels. It's never an exact science when trading like this, as sometimes you don't get the dips riding longs, nor rallies riding shorts. So it can be a case of reacting to the price action by trading breaks. The fundamentals I'm looking for are moving the price that way. That's what I look to do. Now, of course, managing risk is also very important. You know, the rule of thumb for most traders is not to risk more than 1 to 3% of your account on any individual trade. That's something I stick to with most short-term trades, but I'm happy to increase that risk for longer-term trades. The main reason being is that because I may spread my risk over hundreds of pips, my risk can build slowly and I have time to fine-tune things. Maybe the short-term price action suggests I might get a better level than one of the certain levels I'm looking at, which may allow me more room in my risk parameters. So based on the levels, I'll have my first entry point, and from that, I'll have my assessment level where I think I'm wrong if the price breaks that. Now that will give me a starting range to then calculate and build my risk between those 2 points. Now, of course, I may not get any of my entry points before the market starts to go my way, which means my initial risk may be much lower, and I'll have to change to buying the level breaks as the price moves up. Now, all that might mean I don't have an exact idea of the stop level. So until I get to the point where the trade's progressing, I will only have what's called a disaster stop in place. This will be my insurance in case of a crash or some big market moving incident. Now, the management of these trades is very important too. It's not just a question of getting in, picking a target, and then sitting back and waiting until it's hit or stopped. In fact, I don't even bother with profit targets. What I look for, in the same way I use the chart levels for my entries, are the price levels that stand in my way if the trade goes the right way. Because one can't use levels for entry and then try and ignore levels on the way to some pie-in-the-sky target. So what I do is use the levels as places where I might have a decision to make. Do I take profit if a level holds and then re-add on a dip? Or do I hold and maybe add to the position on a break? Now, sometimes through this type of trade management, you can make just as much money cutting and re-adding on the journey as you would if you stuck to the original trades. Now, I'm also not against trading short-term against my own position, but that's a conversation for another time, I think. So to bring it back to the idea itself, the trade will go right if the ECB are pushed into turning more hawkish. And it will be the market expectations that start taking euro-dollar higher. If that does happen, I'll be looking to ride the wave until we get to the same point that we had with the Fed, whereby the ECB language is hawkish and whatever tightening they predict to come gets fully priced in. It'll be at that point I'll be looking to get out. And that'll probably be way before they've actually even acted or changed policy. But what's potentially also good for this idea is that even if the ECB don't comply, the fact that we may be at full Fed pricing may give me the same result if the Fed need to turn less hawkish or bring market expectations down a peg or two. Because as I said, there's always two sides to a currency pair. And so in price move terms, the Fed hurting the dollar has the same effect as the ECB being hawkish to the euro. Now, obviously, you'll also be watching how economies develop over the months ahead, how they adjust to rates moving up, because that will obviously be key for all central banks and any future monetary policy moves. So that's the aim anyway, but as we all know, even the best laid plans don't necessarily work. But when trading over a wide price area, a longer time frame, one can ride out the everyday noise and focus on what the data is doing. And as that's such a slow moving process too, it gives you plenty of time to see whether you're going to be right or wrong. So that's my view for 2022. And I'm also going to be testing the waters of other central banks, particularly the RBA, and as mentioned with Euro Sterling, the Bank of England. But we have a wide range of central banks this strategy can be applied to. And as we all know in trading, there's more than one way to skin a cat. So that's me done, and I thank you for taking the time to listen to me, and I wish you a great trading year ahead.
Great stuff, Ryan. Thank you so much. That was really interesting. And yeah, you know, there's a question that's come through. There's two actually. So the first one relates to what you majorly talked about in this presentation, and it's, you know, the euro US dollar. The consensus is pretty much for a short on the euro US dollar at the moment, but you've obviously highlighted there is that risk of that hawkish pivot by the ECB. What do you think will be the sort of driving factor behind that hawkish pivot? Because what I see is 10 basis points priced in by September already. And I think, you know, Philip Lane wants wage growth at about 3% before they start getting jumpy. And we're at 1.5% at the moment. So what, in your opinion, is really going to get that reversal and that actually see that strength in euro US dollar?
Yeah, I think it's really going to be a case that the ECB, you know, it's as if they're ignoring inflation. You know, as I said, they've been trying to get it for years. Their policy was meant to get inflation up. You know, that's been the case since Mario Draghi uttered his do whatever it takes. You know, I remember being long at 136, I think, odd something, as it was going into 140. And I was sitting in an ECB press conference thinking to myself, Mario, keep your mouth shut, and this is going to be 141 by the end of the presser. And out came the famous words and, you know, everything he was going to do and how, you know, the euro impacts inflation, and bang, that was it, trade blown up, and, you know, it was downhill from there. But the ECB, they move very slowly. They're late to react. I think they keep their head in the sand for too long. You know, here we are seeing inflation across the globe, and they still think it's going to be temporary. And I think that's going to catch up with them. And they're going to be forced to chase it up. Germany's not going to stand for high inflation for too long, but they're in a bit of a pickle because, you know, if they lift rates, then they've got all this huge amount of debt, and the southern nations are going to, you know, get stymied for it. They're going to get blown up for it. It's going to cost them a lot of money. So that's one reason why they want to keep rates low. But they're going to be forced to hike at some point, if only because we're coming out of another crisis and they didn't take their chance last time to hike rates and give themselves some policy room, which is one thing that actually the Fed is doing. And that's what they're good at. They did it after the last crisis when they had the opportunity. They built back that monetary policy margin for the next time the poo hit the fan. The ECB didn't do that, and that's why they're you know, almost ending up like Japan. Lower levels of rates all the time, and they need to get those rates up. So long and short, I think they're going to be forced to hike rates, and that's going to catch the market out or get the market changing, because as you say, they're not predicting anything until later in this year, a 10-bit hike, and I think they're going to be right on that.
So Ryan, before I ask you the last final question, just to recap for any clients that may have missed it, what is that sort of long position target you're looking for in euro US dollar for this thesis to play out? Just to have an actual number.
As I say, I'm reluctant to pick targets. I don't know where the price is going to be tomorrow. I'm sure as hell don't know where it's going to be in 3, 4, 5, 6, 8 months' time. So what I do is once all I'm concerned about when I trade, and this is short-term trades, any trade I do is where I'm going to get in and where I'm wrong. Because once I've got that sorted, everything else is a profit. If I can account for everything there, if I can do as much as I can to mitigate my risk and my loss, or at least accept how much I'm prepared to lose, then all I've got to worry about is where the price goes from there. And then what I do is for the longer term charts, there's lots of levels all the way up. I highlighted a couple on the chart. The big level is down at parity. Obviously, we've got a big level at 105. Top side, you're talking 123s, that sort of area. But there's going to be strong levels in the way. Back as we get up to 120, that's going to be a huge level in its own. So what I do is if the trade is going my way, I look at the levels and I make that decision. When we get to a big level where something may happen, I make a decision. Do I want to take a bit of profit? Maybe if the level holds and I can get out of it, take some money, reload up on a dip. Or conversely, I think, well, yeah, I'm going to sit in this, and maybe if it breaks, I'll add to the position as well. So it's all about, I might be in and out all the way through the position while keeping a core position as we go. And it's really about the expectations. If we get to the point where the ECB is hiking next month, then I'm going to be thinking to myself, okay, now we're here. The same as what we're seeing with the Fed now. We've had a little bit of a dollar rally today over the FOMC. We're not breaking any new ranges. Dollar yen isn't rocketing through the recent highs at 116.35. So, that's what happens with expectations. They run, the market runs, then you get to the point where the central bank is actually acting, and sometimes the market goes the other way.
Great insights there, and thanks for fleshing that out, Ryan. I appreciate it. Just very quickly before we let you go, given that you see sort of this hawkish pivot risk by the ECB, what does that foretell for Euro GBP? And I guess you can also sort of maybe compare that with AUD and NZD, with sort of New Zealand dollar rate pricing being pretty rich and the RBA looking pretty underestimated by the market. So what are your two views on those two crosses quite quickly?
Yeah, quite quickly. So obviously Euro pound is a short I've been in since up near 92. Again, it was a Brexit trade, it was an inflation trade, it was on the Bank of England turning hawkish. I still think there's a more to come from that, so I'm happy to keep my short. I'd like to see it push through this 83 handle, get us down to the 82s, maybe even as low as 81s. I think the Bank of England are going to be forced to be pushed into more of a panic hike cycle, and I think that's going to catch the market out. The market knows they're going to hike, but I think they're going to be forced to go harder and stronger than the market expects. That potential give me a last hurrah jump in the quid, and again, once I get that, I'll be cutting out my shorts and then potentially looking to turn long for the same reason of going long euro dollar, to get the ECB expectations now. Bank of England's done, so to speak. Now we move on to the other side of the pair. Again, the RBA, I've been saying it since last year. The 2024 call, they were talking out their backsides as far as I'm concerned with that. Crazy. These guys don't know what's going to happen tomorrow, and they're calling what they're going to do for rates 3 years' time. So I'm actually long Aussie dollar as well. Been building a position. Started at 75. I'm an average 72.50 odd. Brought it all the way down to 70. Again, I think there's movement to be had there. If the RBA turn more hawkish, that should help Aussie dollar. Kiwi's a funny one. The Kiwi's a perfect example of what happens when expectations get to their point, and when the central bank actually acts. The market, the currency tends to go the opposite way. We've seen, the Kiwi move 100, 200 pips in the opposite direction of what you'd expect when the central bank makes its move, because that's what happens. You know, once it's all priced in, there's no more upside to a company like that.
And I suppose the other downside for the Kiwi is that obviously besides that very frothy level of rate expectations, it's also quite sensitive to risk. So if risk takes a dive, you've got that sort of two-pronged bearish effect on it. But Ryan, we're going to have to leave it there. I could chat to you all night. It's really fascinating, and I'm a fond follower of your thoughts on Twitter. I suggest anybody on this watching should also give him a follow and look at some of his tweets. They really are insightful and really helpful to set that framework. Ryan, thank you so much for coming on, and I look forward to seeing you soon.
Lovely. Thank you.